Well, folks, we have some breaking news. This is literally just breaking moments ago. Elon Musk has come up with a novel idea. He came up with a new proposal. And that proposal, his idea, is to say, you know what, this whole thing between me and Twitter, this arguing back and forth, spending a fortune on lawyers that are bickering over different terms, what if I just propose that we close the deal on the original terms? That's just an idea. What a novel idea. This is what Elon Musk is now proposing. He actually reportedly, and this is still, it's a rumor right now, but it's one of those kind of official rumors is the way that I would phrase that. The billionaire's lawyers sent a letter overnight making the proposal. So there's still a chance this is fake. Maybe it's a total misreport, but all the major news networks right now are reporting this. And usually they like to verify this type of thing. So we'll go into this. I'll give you my quick take on the whole Elon Musk and Twitter saga and how dumb this is and how simple this has been from the beginning. But I also want to do something more in this episode. I want to go over Tesla in general. On the subject of Elon Musk, I think it would be a good time to revisit this company and this stock because we haven't talked about Tesla for a while, and I think now would be a good time to revisit it. And then we also have some other news I want to throw in at the end. This is some bonus news that Amazon is adding a second Prime Day event. This is a little bit shocking to me, unexpected. So I did some investigation into why they're doing this, and there is a reason. So we're going to go through this second Prime Day event that's going to be happening later this month. Now let's go ahead and jump into the major news here. Elon Musk is proposing to close the Twitter deal. And I think this is kind of funny the way they phrase this. He's proposing to close the deal. Really? He's the one doing that? My instant reaction just right off the bat is Elon Musk, if this story is true, if it's accurate, which I believe it probably is, Elon Musk is seeing the writing on the wall. He has his lawyers telling him, look, we are not winning this case. You signed the binding agreement. We're trying to find different excuses to get out of it. We're not finding good excuses. We're probably going to lose the case in what could be a very embarrassing situation. I view Elon Musk as an incredibly intelligent person, incredibly successful, obviously, but also someone that, along with those good characteristics, he has an ego. He wants to protect his view of how other people view him, something naturally that everyone wants to do to some extent. And what he doesn't want is to lose very publicly a very embarrassing lawsuit against Twitter and have Twitter win and Elon Musk lose. And a way that he can try to some degree preempt that loss is by him proposing that they close a deal and then making up a different reason. Oh, it wasn't because I was going to lose. It was because I now changed my mind and I really want to own Twitter. And we found out that the bot issue may have not been as bad as whatever, right? When he's proposing the closure, it puts him in the situation where he can save some face from publicly being court mandated to pay Twitter by a judge. And I think that's the major difference. When I see this news, I see it as Elon realizing he's going to lose this case. And instead of publicly losing and being court mandated by the judge, he wants to preempt it, save as much face as possible, and just pay the original terms. Now, having said that, let's go ahead and read some of the specifics here. Elon Musk has offered to close his $44 billion deal to buy Twitter on the terms he originally agreed to, according to a person familiar with the matter, an unexpected twist that could allow for the two sides to avert a high-stakes trial set to begin soon. The billionaire's lawyers communicated the proposal to Twitter's lawyers overnight, Monday, and he filed the letter confidentially with the Delaware Chancery Court ahead of an emergency hearing on the matter scheduled for Tuesday, the person said. If Twitter accepts the proposal, the two sides wouldn't have to follow through on the 5-day non-jury trial set to begin October 17th. There are no guarantees they'll reach a deal, and the trial could go forth as planned. Mr. Musk was set to be deposed later this week as part of the preparations for the trial. That's the actual report. I think, again, in my opinion right now, this sounds pretty accurate. There's a lot of details there. Usually the news sources won't report on this unless the source is somewhat reliable. Now, what's happened over the past month with this case, what I've seen is a lot of what I consider to be pretty embarrassing text messages from Elon Musk being exposed all over Twitter. And many of those text messages that were private that are now being exposed to the public because they're part of evidence, they don't paint Elon Musk in a good light. I don't think they show him favorably. So I think part of this is Maybe he's just looking at this and realizing it's not worth the effort. He's damaging his reputation to some degree. He's going through all of this nonsense. The guy's so unfathomably wealthy that he can afford to buy Twitter. He did agree to this price. He has funding for it. He can pay for it. And he could just say, you know what? Why am I putting myself through this? I can just buy Twitter, probably improve it over the next 5 years, and maybe even make a profit on it, right? So you can speculate on the different motives for doing this, but I think a couple things are pretty clear. One of them is that Elon Musk's lawyers must not feel highly confident in being able to come out victorious in this case. I don't think they're confident in winning it. The second thing is, I don't think Elon Musk enjoys going through this trial. I don't think he likes this. I think the text messages and the private messages and all the drama this is causing is not good for him, his reputation, or Tesla as a company. And with just those two reasons alone, I think that's enough motive for him to just want to put an end to it and go along with the original agreement. Now, another thing I'll mention is I have been accused of being a Tesla hater or an Elon Musk hater because I view some of the things he does in a negative light. And I don't agree with some of the things he does. I am not an Elon Musk hater. I'm not an Elon Musk cult follower. I view him like anyone else. The reason that I've made multiple videos on this subject of the Twitter and Elon Musk trial, in my opinion, has continually been that he should buy Twitter at the agreed upon price, has nothing to do with punishing Elon Musk. I don't think Elon Musk should be punished by buying a company he agreed to buy. And I don't view that as a punishment. The reason I think that this deal should go through, it should be enforced to go through, is because Elon Musk agreed to it. He signed a binding unilateral agreement to buy Twitter for that price, and he did not carve out exemptions for bots or any other issues. That's stuff that he should have done in part of due diligence before agreeing to buy. In my portfolio, for example, I bought many companies in early 2021. Almost all of those buys are in the red. The entire tech market has gone down 20 to 30% since then. And what do I have to do when I buy a company and it goes down in price? I lose money on the deal. I overpaid for something. Hindsight is 2020. Hopefully I make the money back later, but that's the nature of the game. You agree to buy something and then you own it. And then if the price goes down, you can't back out of it. This isn't Costco. I can't return the stocks later and say, hey, I'm not satisfied with my purchase. I'd really rather have not purchased this for the price. I want to buy it now when it's a lot cheaper, right? We can't do that. This isn't Costco. And I'm not able to reverse these purchases or get out of them. And I think the same rules, generally speaking, should apply to different people, even if they're billionaires, even if they're unfathomably rich. I don't like the idea of an upper class that's so wealthy, they can make buys of companies like, for example, Twitter. The company can drop in value 30%, and then they have a special exemption. They have special ways to get out of it. They can issue an army of lawyers to argue their way out of that purchase. In my opinion, that's unfair. I just think it's unfair. It's not a level playing ground. As investors like you and me, once we buy things, we have to own those purchases. We can't back out of them. Elon Musk signed a unilateral binding agreement to buy Twitter at that price. And I don't think he should be able to use excuses to get out of it, like the whole bot issue, which is something he was fully aware of before buying Twitter. And I'll give you another example. If you think I'm just an Elon hater, and that's my real motive for wanting him to buy Twitter at the agreed upon price, I could give another example here. Jeff Bezos. If Jeff Bezos agreed to buy Twitter, signed a contract, a binding contract, did not give out exemptions for different reasons he can go out of the deal, I would feel identically about it. Not different whatsoever. I would feel that Jeff Bezos should have to buy that company at the agreed upon price. I'd feel the same way about Warren Buffett. If Warren Buffett signed a contract saying he was going to buy a company at an agreed upon price, and then the market conditions changed and the company went down in value, it wouldn't matter. Buffett should have to buy the company at the agreed upon price. So this isn't about Elon Musk at all. It's about contract enforcement. I want to live in a world where contracts actually have meaning. If you sign a contract, you sign a binding agreement, that actually means something. If it doesn't have meaning because you're so rich you can find different ways to get out of it, you have an army of lawyers that can just erase a contract, then that's a really, I think, difficult world to live in. And it makes agreements and trust between different parties very difficult to transact. So that's my take on it. I don't care about punishing Elon Musk. It has nothing to do with it. I don't have a personal bias one way or the other. I don't really care if he owns Twitter. And in fact, I like Elon Musk more than Twitter. I don't like Twitter as a company. I don't really like their values. I don't like the way that they censor things. There's many things that I don't like about Twitter. That was why I was originally excited about the idea of Elon Musk owning Twitter and maybe bringing more transparency and different cool things to it. So this has nothing to do with personal dislike of Elon Musk or liking Twitter more. That's not the case here. So I'll keep following the story. We'll see if these rumors, if this report is actually true, if the deal goes through or if it falls through. But right now, it's still just a rumor. It's not totally official. Now, I want to take a look and move on to Tesla stock. This is a company I get asked about all the time. Investors they're confused. They look at my portfolio and they say, Joseph, look, you got all these great tech companies. A lot of these are phenomenal companies, right? We got the Amazons and Netflix and Microsoft, Adobe's, but you don't have the best one of all, which is Tesla. And I get more and more questions every day about Tesla. It is an amazing tech stock, but I want to go through and explain my thought process and why I don't currently own the stock. Now, before we jump into it, just a quick mention. What you're looking at here is Qualtrim Insights. It is a tool that's part of the Patreon membership. If you join the Patreon today, right now, you will have a free trial until the end of the month. You will not be charged upon joining. So that gives you time to try it out, really test it, and figure out for yourself that this is the best stock tool on the market, bar none. I have full confidence you'll come to that conclusion. I've looked at all of them. I have memberships to all of them. This one is the best. I fully believe that. Now, back to Tesla. First thing I want to mention about this company is a lot of people say I'm a Tesla hater because I speak unfavorably about some aspects of Tesla. I'm not a Tesla hater. A lot of people aren't aware that I actually owned Tesla stock in the Story Fund just a year ago. I had the company in my portfolio. It went up 100% in price in a very short amount of time, and I took gains and moved on to different stocks. So I don't hate the company. I'm willing to invest in it. I have invested in it before, and I will keep it on the watch list, and I may invest in it in the future. I want to explain my thoughts on the company and why I'm not currently invested in it. So the market cap right now is $831 billion. That is a staggeringly huge market cap in a class of the biggest companies in the world. So Tesla's a very big company. The price to sales is 12. That's very high if you are pricing it as an automaker. I know Tesla's more than an automaker. The free cash flow yield is also 0.92%, a very low free cash flow yield for any company. It's lower than Costco, which is supposed to be one of the most expensive companies in the market. It's lower than most companies in any portfolio. So all this basically says is there's a lot of high expectations already baked into the cake for Tesla. It has a lot of performance to do to meet these expectations. So far, Tesla's growth has actually been pretty phenomenal. Phenomenal doesn't even describe it. It's out of this world how good the growth is. Not many companies like it. So far, the expectations, I think, have been met for Tesla shareholders. The company continues to perform very well quarter over quarter, year over year. The growth rates are so insane. We have growth rates of 70% from one year to the next, 47% for the past 2 years. Over the past decade, a 74% compound annual growth rate in the revenue. Phenomenal growth. And that's really what's driven this stock up to its $800 billion market cap. The EBITDA, it looks very similar in crazy growth rates from one year to the next. The free cash flow of the business is also going in the right direction. They had cash outflows while they're doing major investments, building out factories, reinvesting back in their business, I think very effectively. Those cash flows that were going out are now being realized as profits and positive cash flows now. Tesla in 2021 had $3.4 billion in free cash flow. So you look at this, and even in 2021, when they had a decent amount of free cash flow, $3.4 billion in free cash flow is just not a lot for a company that's trading at an $830 billion market cap. You're getting $3 billion of cash flow for an $800 billion price. And that's where you get this free cash flow yield of 0.9%. It's just not a lot of cash produced for the massive size of the actual business, the market cap you're paying. And this, again, is where you have to, if you're a Tesla shareholder, you have to have very aggressive, huge assumptions for the future, that these free cash flows will grow astronomically and continue to grow like they have been well into the future to justify the current market cap. To give a comparison, we can use Apple here. Apple's an even bigger company, but Apple might be 2.5 times bigger than Tesla, but the free cash flow yield is 4.6%. So in terms of actual valuation, Apple is much cheaper unless you factor in some crazy growth rates for Tesla. If we look at the actual cash produced in 2021 for Apple, remember with Tesla, it was $3 billion. With Apple, it's $92.9 billion. 92.9. So Tesla could 20 times their free cash flow in 2021 just to catch up to Apple. That's the differentiation there. Now, I'm not saying they won't do it. I don't know. That's the big problem with me and Tesla. When I look at it, I look at a company that's phenomenal. It's performed very well. But when you have these type of expectations, $800 billion market cap, free cash flow yield of only 0.9%, you have a lot of high expectations, and it puts me in a situation where I feel like I'm taking too much of a risk. Because remember, I've repeated this a few times. There's two basic risks in investing when you're picking out individual stocks. There is the fundamental risk, the risk that the company does not perform as expected, that competitors come in, they take away market share, they grow their earnings at the expense of your company, and you have the company that you're invested in perform worse than expected. That happens to many great investors. No matter how much insight you have of the future, fundamental risk is something to really be concerned about. A company has to have an incredibly wide moat to reduce the risk of fundamental risk. Apple, I think, has low fundamental risk because they have a wide moat. What do I consider to be Apple's moat? Their ecosystem. When you buy one Apple product, you're more inclined to buy another Apple product because they work better together. They all share iPhotos and iMessage. You all have the blue text bubble. You have the FaceTime. So you have a whole ecosystem of Apple products. That is unlike a lot of other companies. If you buy Nike shoes, you don't have to buy Nike pants to make them work better together. But with Apple, everything works better together, and that creates this big ecosystem. So I feel like with Apple, the fundamental risk is lower than other companies. When I look at Tesla, the fundamental risk, I think it's there. I think there is a fundamental risk. I think the company is a great company, but they have intense, well-capitalized competition from all fronts. You have the other automakers like Rivian that are competing and doing the same thing. Then you have every other automaker in the world changing to EVs. We have Ford, for example. This is a company that I'm not invested in. I don't like Ford as an investment, but this company has a note here. Ford Motor Company shares are trading higher after the company reported EV sales tripled in September. They tripled in reportedly September. So we have other companies that are moving into EVs. Will they pose a significant threat to Tesla? Tesla investors will tell you no. No, they don't. Tesla has their factories, they have this huge lead, and the automakers of the past, the traditional ones, they're just way too far behind. They're 10 years plus behind. Tesla's going to continue to keep their massive advantage over these other automakers. I hear the argument, but I'm unsure about it. So Tesla, in my opinion, is a company that has fundamental risk. They have a huge advantage right now. They have the first mover advantage, but they have many competitors throwing a lot of capital into this industry trying to close the gap. And we'll see how well their moat really holds up over the next 5 years. But if you're a Tesla investor, you have to believe that moat is substantial. And I'm just not sure about it. Another thing related to the fundamental risks about Tesla, another thing that I don't exactly love is the same concern I have for every automaker. Right now, Tesla derives the majority of its revenue from auto sales, from selling their vehicles, not from subscriptions, not from insurances, not from software, but from the actual vehicle sales. What that means is that you're investing in a company that's making most of its money selling cars. For the past couple of years, during this astronomical revenue growth, demand for vehicles has been incredible. We've had the Fed pushing money into the economy, giving people extra dough to spend on whatever they want. Now we have the exact opposite happening. Spending is going down. Home prices are going down. Used car sales are declining. Mortgages are at 7%. Less people are buying mortgages. The Fed and the government is not stimulating the economy anymore. They're trying to slow it down. And that puts pressure on companies that sell premium one-time purchases that are above the price of other items like Tesla. Now, how will they do during a recession? I don't know. I'm just unsure. They might do great. Really, demand might hold up, but there is a chance that auto sales, especially for very high-priced vehicles, they might just come down a bit. When I look at other companies, I already know how they're going to do during a recession. Costco is going to hold up just fine. It holds up fine during good times and bad. It's an all-weather stock. With Tesla, I just don't know. That's another uncertainty. So with the fundamental risk, I think that it's there. It's present. And then we have the other risk. Remember, two different risks with companies. One of them fundamental, one of them valuation risk. You have the risk of simply paying too much. Even if the company does well, even if it grows and kind of goes according to expectations, you always have the opportunity of just paying too much, not giving yourself a margin of safety, not giving yourself any buffer room in the stock. Right now, I think there's substantial valuation risk. At $830 billion, even if the company does perform relatively well, they have a lot of growing to do before justifying their current valuation. Generating $3 billion, $4 billion in a company that costs $831 billion, it's just valuation risk. It's a very expensive company, has very high expectations, and I don't see any margin of safety in the stock price right now. So that's the basic reason I don't own Tesla currently. I think the company is amazing. I think the company has a high amount of talent density, lots of smart people working at it. I think they're incredibly bright. I actually like the projects they're working on. I don't have a problem with the bot. I think the bot is actually cool. Even if it doesn't amount to anything in the short term, I think doing those type of experiments are fun. They can also bring up different things you can use in different applications. So I like in general what Tesla's doing. I have no problem with it, but you have to keep in mind the stock doesn't know you own it. You shouldn't have an attachment to a stock. I view these as vehicles or mediums of being able to make money. And I'm always looking for the best risk-adjusted return. So looking at Tesla right now, it's just one that I have on the unsure category. If the valuation comes way down and the valuation risk is reduced, or if I come to believe that Tesla's moat is much bigger than I previously thought, I could change my mind and invest in the company. But that's where I'm at right now. Now, moving on from Tesla, I want to jump into Amazon here. We have some new news that Amazon is having a second Prime Day event. Now, before I go into this news and give my opinion on it, I think it's good to give a disclosure that I am an investor in Amazon. I'm extremely bullish on the company, very confident in its future so far. I like the outlook of it. I'm down a bit on the stock. It's traded down about 20%, so I'm down $10,000, but I continue to buy this one because I really like it. So I am invested in the company, but I had some surprising news come across me when I saw that Amazon is adding a second Prime Day event this year, October 11th and 12th. The 2-day event will continue a recent trend among Amazon holding sales events over multiple days to maximize its revenue. I like that they're doing this over 2 days because sometimes the first day I'll miss it and I'll hear from other people what they're buying and then I'll get some items the second day. So I like that you're not nailing it down to just 1 day. The 2-day thing I think is a good move from Amazon. Amazon already offers Prime members a July shopping extravaganza on its annual Prime Day. The company said customers purchased more than 300 million items during its July Prime Day event. So they sold a lot of items. It was way more than their normal sales. Consumer prices rose 8.3%, and it goes on just highlighting this deal. So that's basically it. Now, I think there's 2 basic ways to read this news. There's 2 different takes you can have from it. One of them is that this is not good news for Amazon. This is Amazon being desperate. Their numbers are bad. Their sales are declining. They're coming up with a lot of competition. So they're getting desperate and offering this Prime Day event. And even worse, they have a bunch of junk sitting around that they can't move. They can't sell it because the consumer is so weak. So they're like, you know what? Let's just throw in another Prime Day. Let's mark this stuff down, make it a big event, and get this stuff out of here. That's one take from it. Another one is that they're now being highly competitive and they're doing this as a preemptive assault on other retailers. They're going after Target. They're going after Walmart. They're going after Costco by offering a massive sales event right in the middle of the holiday season. I think both of those takes are completely valid. I think they're both true at the same time. I don't think it's one or the other. We know that there's inventory issues for a lot of these retailers. Nike's inventory woes stretch to China as COVID remains a challenge for the brand. Nike reported having 60% more inventory up year over year, which is a massive increase in inventory. Another way of saying that is because of different problems with logistics and ordering that's happened over the past year, these companies are ending up with too much stuff. When they have too much stuff, it's expensive to store it. If you run a big business and you're selling billions of dollars worth of items, you have to put that stuff somewhere. Right now, warehouses are very expensive, and keeping inventory is also expensive because you can't order in the seasonal stuff that you really want to have on the shelves. So you're stuck in this conundrum as these companies. You either have stuff that you can sell the next year that you keep on the shelves and you have available storage. That's what Costco's doing. Costco luckily has a lot of storage and they're not hurt by their extra inventory. So they can just keep it around until things go down a little bit and sell it later. Nike, on the other hand, says that they're going to have to discount stuff like crazy. So on the Nike app and the Nike website right now, you'll see a lot of sales events going on with Nike because they want to get rid of their non-seasonal stuff to get their new items on the shelves. That's the problem with Nike. It's called the bullwhip effect. This is something where they say the effect describes the tendency of a business to overestimate the amount of inventory they will need for a range of reasons. Fear of lost sales, the misreading of the market, so on and so forth. Then as they order more and more stuff and it comes late, all of a sudden they have way too much stuff. They're ordering too much stuff at the same time and they have that excess of inventory. Amazon is facing the same problem. They have inventories that are up something like 60% over the past year, similar to Nike. Way too much inventory, way too much stuff to sell. So Amazon has a choice. They can either hold on to that stuff, they can have it cost them a lot of money in storage and different ways that they could possibly use that storage, or they can make it an opportunity. They can use the excess inventory as an excuse to offer another massive sales event that will also steal market share from their competitors. And I think this is exactly what they've chosen to do. They have excess inventory, they have lots of goods that they need to get rid of, and they're going to turn it into a big sales event to put pressure on the competition. And I think this strategy will probably work. I think it will reduce their inventory. It'll have a lot of sales. They'll make money from it, and they'll have the effect of taking market share from their competition. And one difference I would say between a company like Amazon and a company like Nike is Nike's value. The reason that people pay so much for Nike shoes, which are commodities, it costs like $10 to make a Nike shoe. The reason that people pay so much for it is the brand value. When Nike lowers prices, that diminishes the brand value to some extent. I really think it does. It's the same thing that happened with Peloton. When they lowered prices, diminishes brand value. With Under Armour, when they started lowering prices and giving discounts, it diminishes the brand value. So I think in the case of Nike, doing all of this sales and getting rid of excess inventory is more risky and more damaging because their brand is about having the Nike name, the high brand value that comes along with it. When I look at Amazon, their brand, their whole branding is about having the cheapest prices, the best value. So offering this huge sales with discounted prices, I don't think destroys brand value. In fact, I think it does the opposite. I think that it increases brand value. So in the case of Amazon, I actually think this will increase their brand value. In the case of Nike, I think this could actually work the opposite way. Having too many discounts, too many sales, offloading too much stuff at once might tarnish their brand value slightly. Although I think it's strong enough to endure it. So that's my thought on this. I think that overall, this isn't such a bad thing for Amazon. They're taking a problem, which is excess inventory. They're turning it into a solution, which is another huge event, and they're putting pressure on their competition. So that's my thoughts overall. I hope you enjoyed the news, and I'll see you in the next one.